Toomey and his staff, thank you for working with me and my staff to try to secure Mr. Bankman-Fried's testimony. I trust that he will soon be brought to justice. It's clear he owes the American people an explanation. Meanwhile, our job is to keep learning more about the collapses of FTX and other crypto firms, and I emphasize and other crypto firms, work with regulators to put consumers, not the crypto industry, first. It's not just about crypto, it's about protecting consumers, the regulated financial sector, from bad actors who think rules simply don't apply to them. 2.5 years ago, I explained why I thought Facebook's Libra currency was dangerous. At the time, Facebook was moving full steam ahead, as most of you know, to create its own currency, put that in quotation marks, to impose on its billions of users. Congress, regulators, and policymakers saw Facebook Libra for what it was, a shiny new tool Facebook could use to reach into Americans' pockets and profit from, no matter the risk to consumers or to our economy. Members of this committee, others in Congress responded. Republicans and Democrats alike made it clear that Facebook couldn't be trusted. Our financial system was not to be played with. The risk of a company creating its own currency to compete with the US dollar was obvious. Ultimately, Facebook shut down its crypto project, but the committee's work to protect consumers, of course, continues. Even though Facebook shelved its crypto plans in the last 2.5 years, the stablecoin market has grown 20 times to become a tool for rampant speculation. The number of crypto tokens has exploded, even as the total value of all crypto assets fell by two-thirds in the last year. I've noted in the past similarities that cryptocurrencies share with risky mortgage bonds and over-the-counter derivatives during the lead-up to the financial crisis. In all these cases, they told us how great innovation is and how derivatives make markets efficient. Wall Street made it easy for everyone to get a mortgage so bankers could create more mortgage bonds and increase profits. Making money in crypto seems so easy, too easy. Every crypto token could double or triple in value in a matter of hours or days. It didn't matter if it was created with vague details or as a joke, money still poured in. No one's laughing now. The weekend before our stablecoin hearing last February, we saw crypto companies spending big money on Super Bowl ads to attract more customers and pump up crypto tokens. I appreciated the comments of one of you in this panel on public radio today about that. Crypto, like Facebook's Libra before it, was the shiny tool supposed to capture our imagination and revolutionize our lives. Wealthy celebrity spokespeople told Americans, if you're not buying crypto, you're missing out. Crypto platforms created dozens of investment products that look and sound like bank deposits, using words like lend and earn, or tokens that resemble securities and have a yield or governance rights, yet these products had none of the safeguards of bank deposits or securities. Crypto firms, their backers argued that billions of dollars invested in lending programs or earning yield should be exempt from basic oversight and regulatory protections. That's not how regulation works. The things that look and behave like securities, commodities, banking products need to be regulated and supervised by the responsible agencies who protect the public and serve consumers. Crypto doesn't get a free pass because it's shiny and bright, or because venture capitalists think it might change the world, or its TV campaigns were witty and featured famous people, especially when so many consumers are at risk of losing hard-earned money. And that's before we even consider how crypto has ushered in a whole new dimension of fraud and threats to national security. People are talking about that more and more because it's a central issue in this, that support dangerous nation states, embolden criminals, finance terrorists. North Korea uses crypto stolen in hacks to finance its ballistic missile program. Think of that. Human traffickers, drug cartels, gun runners launder their proceeds using crypto assets. Think of that. And some of these laundered funds end up bankrolling terrorists bent on undermining our nation and our society. Think of that. The ability of rogue states, cyber criminals, terrorists to use crypto for their own malign purposes is a feature of technology, and that's the point. Crypto also has made it easier for fraudsters and scammers to steal consumers' money. Hacks and complex crypto transactions make it easy to steal billions of dollars of investors' money. That's what we saw with FTX. That's what will continue as long as we allow crypto firms to write their own rules. The myth of Sam Bankman-Fried and his crypto trading success was supposed to impress us. We're still learning how he shuffled money between FTX and his trading firm, Alameda Research, a name calculated to sound as generic as possible to avoid raising eyebrows while sending money across the world. FTX and Alameda Research took advantage of the crypto industry's appetite for speculation. They were able to borrow and lend from other platforms and invest in other crypto firms, inflating the crypto ecosystem and growing their own profits. Even this summer, as crypto values crashed and platforms began to fail, FTX and Alameda found ways to benefit. In one case, FTX made a $250 million loan to a platform. Using its proprietary token, and Alameda borrowed client deposits worth more than twice that from the platform. All the while, venture capitalists and other big investors, shame on them, fell for it. They were caught up in the speculative frenzy, missed the red flags, and FTX showered Mr. Bankman-Fried with more and more money, and now it's most likely gone. It's no surprise in 2018, Alameda solicited investors by guaranteeing 15% returns with no downside. That's more than the guaranteed 11% that a guy named Bernie Madoff offered. With Madoff and with Sam Bankman-Fried, investors didn't ask questions for fear of missing out. It's a good reminder that most guaranteed investments are, in fact, too good to be true. In this story, Bankman-Fried was the shiny object. Now he's the villain, possibly worse. But this story is bigger than one person or one firm, and that's the point of this hearing. It's not just about misconduct at FTX, but about how to protect consumers in the financial system from unregulated crypto projects. For many investors, it might be too late. I've heard from far too many Ohioans who have money stuck at FTX. .us that they tried to get out before it filed for bankruptcy. But despite Bankman-Fried's assertion that the U.S. side of FTX should be fine, court proceedings are likely to drag on and on. If we're going to learn from FTX's meltdown, we must look closely at the risks from conflicts at crypto platforms that combine multiple functions. It means thinking about the kinds of disclosure that consumers and investors really need to understand how a token or crypto platform works. We can look to existing banking and security laws for time-tested approaches to oversee and examine entities that want Americans to trust them with their money. To protect consumers in the financial system, we need a comprehensive framework that looks at crypto products for what they are, not looking at these products the way crypto executives want them to be or want to tell us they should be. I look forward to working with Treasury Secretary Yellen. We've been working with her to step up and lead this government-wide regulatory approach, and the other financial regulators to ensure there's an all-of-government approach, just as we've done in the past. Anything less simply won't work. Senator Toomey.
Thank you, Mr. Chairman, and I want to thank our witnesses for joining us this morning. We're here to discuss the fallout after the collapse of FTX, and some Americans very likely suffered significant losses from the bankruptcy of FTX and Sam Bankman-Fried's misconduct. On Monday, we saw the arrest of Mr. Bankman-Fried, and this came as a surprise to no one, with the possible exception of Mr. Bankman-Fried. We owe it to each customer to get to the bottom of the FTX implosion, and any violations of the law should be aggressively prosecuted. The Department of Justice and other enforcement agencies should expeditiously investigate the unseemly relationship between a company that was effectively a hedge fund and an exchange entrusted with customer funds. While all the facts have not yet come to light, we've clearly witnessed wrongdoing that is almost certainly illegal. There was unauthorized lending of customer assets to an affiliated entity, and there were apparently fraudulent promises to investors and customers about FTX's operations. These are outrageous and completely unacceptable.
Yeah, they're like...
The SEC also believes that FTX committed fraud against equity investors. They're going to pursue that, as they should. But I want to underscore a bigger issue here, and that is that the wrongful behavior that occurred here is not specific to the underlying asset. What appears to have happened here is a complete breakdown in the handling of those assets. In our discussion of FTX today, I hope we're able to separate the likely illegal actions from perfectly lawful and innovative cryptocurrencies. Now, it's important to define this space. Cryptocurrencies are analogized to tokens, but they're actually software. The software protocols that are foundational to the crypto ecosystem are like operating systems, and then applications are run on top of these operating systems. Currently, there are many competing operating systems and many apps running on them. There's nothing intrinsically good or evil about software. It's about what people do with it. And with this analogy in mind, what we should all understand here is one simple thing. The code committed no crime. FTX and cryptocurrencies are not the same thing. FTX was opaque, centralized, and dishonest. Cryptocurrencies usually are open source, decentralized, and transparent. To those who think this episode justifies banning crypto, and I've actually heard that suggested, I'd ask you to think about several other historical parallels. The 2008 financial crisis involved obvious misuse of products related to mortgages. Did we decide to ban mortgages? Of course not. A commodity brokerage firm run by former New Jersey Senator John Corzine collapsed after customer funds, including U.S. dollars, were misappropriated to fill a shortfall from the firm's trading losses. Nobody suggested that the problem was the U.S. dollar or that we should ban it. With FTX, the problem is not the instruments that were used. The problem was the misuse of customer funds, gross mismanagement, and likely illegal behavior. So let's talk about what comes next. Some of my colleagues have suggested somehow pausing cryptocurrency before we pass legislation. This is a profoundly misguided, not to mention impossible idea. Short of enacting draconian authoritarian policies, cryptocurrency cannot be stopped. If we tried, the technology would simply migrate offshore. Cryptocurrency does not need brick and mortar facilities to operate. And typing computer code should clearly be seen as a form of protected speech. Are we going to decide to pause the Constitution in order to stop crypto? This is exactly the kind of mindset that has driven this activity to the darker and less regulated parts of the world. Now, if Congress had passed legislation to create a well-defined regulatory regime with sensible guardrails, we'd have multiple U.S. exchanges competing here under the full force of those laws and regulations. In that scenario, it's not clear that FTX would have ever existed, at least on the scale that it did, not if we had American companies that were an alternative and properly regulated. The complete indifference to an appropriate regulatory regime by both Congress and the SEC probably contributed to the rise of operations like FTX. Others have suggested that we refrain from addressing cryptocurrency at all because we wouldn't want to legitimize its use. Well, I think that is both misguided and irresponsible. Congress can and should offer a sensible approach for the domestic regulation of these activities. I think we should start with stablecoins. This is an activity that my colleagues, we can analogize to existing traditional financial products. There's clear bipartisan agreement that stablecoins need consumer protections. There are virtually none in place now. I've proposed a framework that would do that. Senator Lummis and Gillibrand have also proposed a framework. Congress also needs to determine the criteria and the disclosures by which issuance of digital assets will be regulated. And we should acknowledge the possibility that there's certain token issuance like Bitcoin that don't need that kind of regulation. We should also clearly delineate regulations for the secondary market trading of these assets, including at exchanges like FTX US. Some of my colleagues have begun this important work. We can provide sensible consumer protections for which there would be very broad agreement while still allowing for the development of applications that are going to run on operating systems that we can't even imagine today, just as I don't think any of us ever imagined applications like Uber operating on iOS today. So let me conclude with this. It's absolutely essential to investigate any fraud and violations of existing law and prosecute those who are committing those crimes. Congress owes it to the American people to do so. But this is fundamentally not about the kind of assets that were held by FTX. It's about what individuals did with those assets. Individuals can be tremendously empowered by the use and access to cryptocurrencies. Cryptocurrencies can protect against inflation when governments irresponsibly manage their own currencies. They can provide useful services without the need for a company or a middleman. And they can let individuals preserve the freedom to transact privately. Mr. Bankman-Fried may well have committed multiple crimes. The SEC and DOJ will determine that. But let's remember to distinguish between human failure and the instrument with which the failure occurred. In this case, the instrument is software, and the code committed no crime. And while Sam Bankman-Fried very well may have, it's important we not convict the code of anything but preserving and protecting individual autonomy. Thank you.
Thank you, Senator Toomey. I'll introduce today's witnesses. Starting on my left, we'll hear from Professor Hillary J. Allen from the American University Washington College of Law. She has testified in this committee remotely last year, I believe. Mr. Kevin O'Leary, an investor, television personality, and founder of several companies. Mr. O'Leary, welcome. Ms. Jennifer Schulp, the Director of Financial Regulation Studies at Cato Center for Monetary and Financial Alternatives. Ms. Schulp, welcome. And Mr. Ben McKenzie Schenken, an actor, writer, director, is co-writing a book on cryptocurrency and fraud. Mr. Schenken, welcome. And Professor Allen, please begin.
Chairman Brown, Ranking Member Toomey, and members of the committee, thank you for inviting me to testify today. My name is Hillary Allen, and I'm a professor of law at the American University Washington College of Law, and I'm the author of the book Driverless Finance, FinTech's Impact on Financial Stability. I would like to make 3 points today. The first is that FTX's failure was not an isolated incident, but is symptomatic of many broader problems in the crypto industry. FTX is just the latest in a series of major crypto industry failures. Failures of centralized crypto intermediaries like Celsius, and failures of DeFi offerings like Terra Luna. These failures arose in large part because of a feature that is unique to the crypto industry. Crypto assets can be made up out of thin air. When assets can be made up out of thin air, that generates leverage that makes the whole system more vulnerable to booms and busts. When assets can be made up out of thin air, they can also be used to obscure financial realities, as was done with FTX's FTT tokens, which were used as collateral for the FTX customer assets loaned to Alameda. How can you have any reliable check on the valuation of an asset with no productive capacity behind it? The attestations and proofs of reserves offered by the crypto industry are poor substitutes for rigorous and independent audits. Such an environment is highly conducive to fraud. Sam Bankman-Fried may have engaged in good old-fashioned embezzlement, as it was put yesterday, but the embezzlement was able to reach such a scale and go undetected for so long because it was crypto, shrouded in opacity, complexity, and mystique. To be clear, decentralization won't protect us from future crypto frauds, because even if DeFi is technologically decentralized, it is not economically decentralized. If one person owns 90% of the governance tokens that control the software, which is quite common in DeFi, then they could cause it to perpetuate shady behavior. The second point I want to make is that when we talk about regulating crypto, we're often not being specific about the type of regulation we mean to apply. There are several different options. A ban on crypto, for example, would be the most straightforward way of protecting both investors and the financial system. And because crypto isn't really decentralized, it is possible to enforce such a ban. If policymakers don't wish to proceed with a ban, then they will need to be careful to ensure that any laws that they do adopt don't inadvertently make crypto too big to fail. Crypto should not be regulated like banking products, because that would give crypto access to the government support that we afford to banking because of its critical role in providing credit and processing payments for the broader economy. Banking regulation should, however, continue to keep actual banks away from crypto. The harm from FTX's collapse has been limited to those who invested in crypto, but allowing crypto to integrate with the rest of our financial system could cause a broader financial crisis that would hurt those who never even invested. Investor protection regulation, as opposed to banking regulation, doesn't come with any deposit insurance or lender of last resort. It doesn't signal that an investment is a good investment or that an investment won't lose value. Robust enforcement of the securities laws could make significant strides in protecting U.S. investors without conveying the message that crypto is too big to fail. The SEC has been very clear in its public statements that most crypto assets are securities. But Sam Bankman-Fried and the rest of the crypto industry weren't looking for this clarity on the current law. They were looking for changes in the law that would accommodate the industry. In particular, they wanted to be regulated by the CFTC and not the SEC. I respectfully submit that Congress should not adopt legislation to that end that was endorsed by Sam Bankman-Fried. In particular, because the proposed CFTC self-certification regime for crypto assets would allow the unlimited supply of crypto assets to continue to proliferate. Energetic enforcement of the SEC's existing securities registration requirements, on the other hand, would make it a lot harder to make crypto assets up out of thin air. If Congress wishes to provide more clarity and certainty to the crypto industry, they could adopt legislation that categorically provides that all crypto assets are indeed securities. The final point I want to make is that if we have little to lose from limiting the growth of the crypto industry. The underlying blockchain technology can never deliver on the industry's promises, both because the technology itself is not very good and because technology is only a tool. After 15 years without a killer app, it is time for policymakers to listen to the technologists explaining why blockchain technology is fundamentally not fit for purpose. Even if it were good technology, though, it would not fix the underlying political and structural problems that limit access to financial services. In many ways, relying on the crypto industry to improve access to financial services is like adopting a policy to open more casinos in underserved communities. And to those who say that crypto investment is a matter of personal choice, crypto creates problems even for those who choose not to invest in it. It facilitates ransomware attacks, sanctions evasion, tax evasion, has significant environmental consequences, and, as I've already discussed, could cause financial crises if allowed to integrate with the traditional financial system. I would submit that the United States should not want to be a world leader in the worst kind of innovation that allows its suppliers to profit handsomely but offers little benefit to society and, in fact, inflicts a multitude of harms.
Thank you, Professor Allen. Mr. O'Leary, welcome.
Thank you very much. Chairman Brown, Ranking Member Toomey, and members of the committee, thank you for inviting me to testify about crypto and the collapse of FTX. I'm the chairman of O-Shares, an ETF indexing firm, and also a private equity and venture investor. I support entrepreneurs at every stage of their journeys. I have dozens of family-run businesses in our investment portfolios. My extensive social media platform enables me to tell the stories of their products and services to help reduce their customer acquisition costs. It's a model that has worked well for over a decade and helped support so many small American businesses, which create over 60% of the jobs in the American economy. In 2017, I was a public critic and skeptic of crypto and blockchain technology. As the global regulatory environment began to open up in 2018, I began to invest. Now I am a shareholder in multiple companies involved in crypto technology, including WonderFi BitBuy, the largest and first regulated broker-dealer crypto exchange in Canada, Immutable Holdings, a developer of NFT technology, and Circle, the company that brought USDC stablecoin to market. I've also invested in multiple crypto tokens, infrastructural level 1 and level 2 blockchains. I am of the opinion that crypto, blockchain technology, and digital payment systems will be the 12th sector of the S&P within a decade. Many of these technologies are going to disrupt the existing financial services sector with faster, more efficient, more productive, and more secure ways of investing, paying, transferring, and tracking assets. As you are aware, Bitcoin, a store of value, is not a coin. It's software. Ethereum is software. Blockchain is software. In the last 30 years, every American enterprise has driven major efficiencies using various versions of enterprise software, and crypto is no different. The potential of these crypto technologies is astronomical in scale. In August of 2021, nearly 3 years after I started allocating capital to the crypto sector, I entered into an agreement with FTX to be a paid spokesperson. I was paid approximately $15 million for these services, plus approximately $3 million to cover the portion of the taxes due. Of the remaining amounts, approximately $1 million was invested in FTX equity and approximately $10 million in tokens held in FTX wallets. The equity is now most likely worthless, and the accounts have been stripped of their assets and, interestingly, financial records. I've written all off to zero. Because I was a paid spokesperson, however, I never invested any capital from our partners or LPs in FTX. The capital lost was from an operating company that I had 100% ownership in. I'm using my own capital to pursue record recovery of the FTX accounts so I can conduct a forensic audit. The truth of this situation will be discovered by following the transaction trail after obtaining the records. I've applied for membership on the FTX Creditors Committee in connection with the bankruptcy proceedings because I feel obligated to pursue the facts on behalf of all stakeholders and believe my perspective of this situation will be helpful to the other creditor committee members. The collapse of FTX is nothing new. While this situation is painful for shareholders, employees, and account holders, in the long run, it does not change this industry's promise. Enron came and went and had no impact on the energy markets. Bear Stearns, Lehman Brothers' demise had no impact on the long-term potential of American debt and equity markets. I'm only one of many investors that have experienced this loss. However, this changes nothing in terms of the potential of crypto. In fact, the recent collapse of crypto companies has a silver lining. This nascent industry is culling its herd. Going or gone are the inexperienced or incompetent managers, weak business models, and rogue, unregulated operators. Hopefully, these highly publicized events will put renewed focus on implementing domestic regulation that has been stalled for years. Other jurisdictions have already implemented such policies and are now attracting both investment capital and highly skilled talent. In the U.S., we are falling behind and losing our leadership position. I understand why many leaders in the banking industry are open skeptics, calling for the banning of these new crypto software technologies. Disruption is always uncomfortable at first, and entrenched businesses abhor new competition. But it has been proven time and time again that disruption is absolutely necessary in advancing the economy. There is the risk of investing in crypto, and then there's also the risk of not investing in it and letting others accrue its benefits first, essentially gifting them a competitive advantage that could be very, very hard to recapture. So where to start? We need to clear policy and regulation for the crypto industry, its entrepreneurs, its developers, and its users. Congress should start by passing bipartisan legislation that creates a sensible regulatory framework for digital stablecoins backed by the US dollar. Why? A well-regulated stablecoin backed by the US dollar and other high-quality liquid assets could become the global default payment system over time. The US dollar already denominates the price of oil and other commodities. Why not everything else? What could be more bipartisan than this? Let me close with this. We need to get to the bottom of what happened with FTX, but we can't let its collapse cause us to abandon the great promise and potential of crypto.
Thank you, Mr. O'Leary. Ms. Schulp, welcome.
Thank you. Chair Brown, Ranking Member Toomey, and distinguished members of the Senate Committee on Banking, Housing, and Urban Affairs. My name is Jennifer Schulp, and I'm the Director of Financial Regulation Studies at the Cato Institute's Center for Monetary and Financial Alternatives. Thank you for the opportunity to participate in today's hearing. At the outset, I note that because the facts are developing, it is premature to definitively diagnose the causes of FTX's demise. Claims of fraud and contractual breaches should be vigorously pursued, and courts should determine what crimes and violations took place. Importantly, the issues with FTX do not appear to be intrinsically tied to cryptocurrencies or other blockchain technologies. John Ray, the company's bankruptcy CEO, described the situation as a complete failure of corporate controls and a complete absence of trustworthy financial information. These risk management failures, whether the result of intentionally fraudulent practices or the product of gross negligence, should reflect on the perpetrators themselves, not on the crypto ecosystem. Today, I suggest 3 takeaways for policymakers. First, there are important distinctions between centralized entities and decentralized projects. Policies designed to address risks posed by centralized financial intermediaries should not be blindly applied to decentralized projects. FTX is, at heart, a traditional middleman. As a centralized exchange, and like a traditional bank or broker, FTX took possession of people's assets and kept the books, however poorly. Decentralized finance, or DeFi, seeks to mitigate these intermediary risks through technology. While designs vary, decentralized exchanges utilize open-source software to provide exchange services by, among other things, publicly recording transaction data and allowing users to self-custody assets. That's not to say that decentralized exchanges solve every problem or eliminate every risk, or that DeFi is always preferable to centralized finance. Rather, the point is that different risks ought to be treated differently. Second, unclear regulation remains a problem that can drive innovation offshore. A rational regulatory framework should distinguish between projects that reproduce the risks of traditional finance and those that mitigate those risks through disintermediation. For exchanges to provide rules that are narrowly targeted to relevant risks, Congress should provide for centralized marketplaces to register with the CFTC for crypto commodities and the SEC for crypto securities. Decentralized exchanges should be permitted to voluntarily register, which recognizes their capacity to address intermediary risks through technology. Addressing marketplace regulation, though, is only part of the task. It is also important to clearly define when crypto projects trigger securities regulation to determine which regulator oversees trading and what customer protections are appropriate. Federal securities law is appropriately applied to address the specific risks of fraud, deception, and manipulation by developers, sellers, or promoters who are active managers of a crypto project. But where no individual or entity acts like a manager, Congress should clarify that securities laws do not apply. Congress should also provide a disclosure option for decentralizing projects that covers information relevant to crypto purchasers. Finally, following FTX's bankruptcy, there have been the usual calls to protect consumers by banning crypto, or paradoxically, by declining to regulate crypto to delegitimize it. This type of protection, premised on a value judgment about the worth of the crypto ecosystem, takes the choice to engage in technological innovation out of the hands of consumers, investors, and entrepreneurs, and wrongly places it in the government's hands. While circumspection around a novel asset class and technology is more than fair, blocking access to an instrument that approximately 1 in 5 Americans already have chosen to use for diverse purposes, from trading to sending remittances, is entirely different. That crypto has yet to meet all of the goals that it or others have set is not a reason to limit access. Moreover, the risk that some people will lose money does not justify harsh regulation. Risk is a natural component of markets, and failure is often necessary for development. Americans should be able to participate, for better and for worse, in that process. Thank you, and I welcome any questions you may have.
Thank you, Ms. Schultz. Mr. Schenken, welcome.
Thank you, Mr. Chairman. Chairman Brown, Ranking Member Toomey, members of the committee, thank you for inviting me to testify before you today. This hearing has been called for 2 reasons. The first is to examine the spectacular collapse of the crypto exchange FTX and its sister company Alameda Research, both owned by Sam Bankman-Fried. These companies, valued at more than $32 billion earlier this year, are today worth less than nothing. In fact, they are $8 billion in the hole. The demise of FTX and Alameda represent the most spectacular corporate downfall since Bernie Madoff's Ponzi scheme imploded in the wake of the great financial crisis. It has captured the nation's attention. Like Madoff, FTX and Alameda owe enormous sums to supposedly sophisticated investors such as venture capital firms and hedge funds. And like Madoff, they also owe a lot of money to regular people. However, the carnage at FTX is far more widespread. Madoff defrauded some 37,000 clients. FTX claims 32 times that amount in the US alone. According to FTX, some 1.2 million retail traders, AKA regular folks, and 5 million worldwide have lost access to the money they entrusted to FTX. It is unclear when, if ever, they will get any of that money back. The harm to those consumers, I would prefer the term investors, is the second reason we are here today, and it is fitting that I am here, for those people are the focus of my attention. I believe they, and the estimated 40 million other Americans who have invested in cryptocurrency, have been sold a bill of goods. They have been lied to in ways both big and small by a once seemingly mighty crypto industry whose entire existence, in fact, depends on misinformation, hype, and yes, fraud. The first lie is the most obvious. Cryptocurrencies are not currencies by any reasonable economic definition. Anyone with even an undergraduate degree in economics, such as myself, can tell you that money serves 3 functions: medium of exchange, unit of account, and store of value. Cryptocurrencies cannot do any of the 3 well, and they have no hope of ever doing so, for reasons I am happy to discuss at greater length during our session. But in the interest of time, let's keep it simple for now and focus on the present. If cryptocurrencies are not currencies, then what are they? Well, what do they do? How are they used? Via FTX, Binance, and a host of other exchanges, usually domiciled overseas, millions of Americans have used real money to purchase some of the over 20,000 cryptos in existence today. According to a recent Pew study, they are doing so as an investment, a way of making money. So, what do we have in the eyes of the law? We have an investment contract, more precisely, a security, an investment of money in a common enterprise with the expectation of profit to be derived from the efforts of others. To my mind, the 4 prongs of the Howey test are easily satisfied by every coin, token, or whatever nonsense words the crypto industry attaches to lines of code stored on ledgers called blockchains in an attempt to convey legitimacy or technological sophistication to them. But if these cryptos are securities, they are bizarre ones. They offer no products, no services, no revenue streams. The projects they represent accomplish almost nothing in the real world that cannot be done better by other means and add no overall value to our economy or any other. They are at best a vehicle for speculation, an exercise in a zero-sum game of chance, much like online poker. At worst, they are an instrument of crime. Surveying the cryptocurrency mania during the summer of last year, I came to a terrifying conclusion. The supposedly multi-trillion-dollar industry was nothing more than a massive speculative bubble bound to pop. Worse than that, I had myriad reasons to believe that the crypto bubble was built on a foundation of fraud. Investment contracts that are effectively valueless are often described as Ponzi schemes, which are regulated under American law by the Securities and Exchange Commission. In my opinion, the cryptocurrency industry represents the largest Ponzi scheme in history. In fact, by the time the dust settles, crypto may well represent a fraud at least 10 times bigger than Madoff. The fact that it has roped in tens of millions of Americans from all walks of life, as well as hundreds of millions of people worldwide, should be of concern to us all. Thank you for your time. I look forward to your questions.
Thank you, Mr. Schenken. My first question I would like to ask all four of you, and please give as close to a yes or no answer as you can. The world is troubled by the extent of the fraud and misconduct at FTX. We all agree on that. Too many people have lost money they thought was safe. Some have suggested that what we see at FTX was unique, a one-off caused by one immoral fraudster rather than something more widespread and systemic. So starting with you, Professor Allen, does this kind of carelessness, misconduct, or worse exist at other crypto firms?
Yes.
Mr. O'Leary?
Yes, the unregulated crypto firms.
Ms. Schultz?
Most likely. Most likely.
Ms. Schenken?
It's endemic.
Okay, thank you. Professor Allen, we know that FTX was over-leveraged, but look beyond, as you did in your testimony, beyond FTX. Given that a lot of crypto trading recycles one token into another, often with borrowed money, it seems as if the value of crypto has detached itself from the actual currency that was originally invested. Is it possible to determine how much leverage there is in the crypto market? And if it isn't, why is that a problem?
Well, I don't think it's possible to determine. I think researchers have really struggled to find data in this space, notwithstanding that people say that the blockchain is sort of transparent. In fact, a lot of transactions happen off-chain. There are a lot of sort of backdoors in software. So the data is not available to figure out what transactions have happened. And you know, the accounting around the individual crypto assets themselves can be very dodgy as well. So, you know, even before you lose track of them in transactions, it's not clear what they were worth up front. So for all of those reasons, it's very hard to get a bead on what the leverage is in this space, and that's problematic because, as we saw in 2008, when you don't understand how much leverage is in the system, you don't understand how fragile it is.
Thank you. Mr. Schenken, your testimony highlights the similarities between crypto and gambling. Based on your research, can you describe the parallels between gambling and stablecoins as casino chips?
Sure. Economically speaking, these are zero-sum games, strictly competitive. For someone to win, someone else has to lose. That does not mean the distribution is even. We know at this point most people who have invested in cryptocurrency have lost money. We know that from the industry's own research. Grayscale December 2021 report said that 55% of people who have ever bought Bitcoin bought it that year. Given the current price of Bitcoin, those people have lost money. That does not include the people who have been locked out of their accounts. The list is very long. I included in my written testimony. So this is gambling. This is speculation. At best, zero sum. That's not including the environmental costs that Bitcoin incurs. There are also members of the industry who come from online poker. I would refer you to Stuart Hoegner, general counsel of a company, Tether, stablecoin company. He was former compliance officer of Escapsa, which was the holding company of Ultimate Bet. Ultimate Bet, from the online poker era, had a secret God mode where players could defraud could see the other players' cards in order to defraud them, in order to win at poker. Stuart Hoegner was joined at Escapsa by Daniel Friedberg. Daniel Friedberg was the former general counsel of FTX. He is now their chief regulatory officer. Alameda, FTX's sister company, is Tether's biggest client.
Thank you. Last question, again, if you would answer as close to yes or no as you can. I want to talk about solutions. FTX, like other crypto firms, perform multiple roles in crypto trade. It acted as an exchange, and as a broker, it provided margin to investors. FTX was essentially on every side of every transaction. Combining these functions undermines the fundamental regulatory checks and balances that exist to protect consumers and to protect our financial system. Should there be, my question, starting again with you, Professor Allen, should there be strong rules addressing related party transactions and creating firewalls between related entities?
Absolutely, to address conflicts of interest.
Thank you. Mr. O'Leary?
I find the analogy of crypto to be that of gambling and speculation interesting. That was exactly what we described the New York Stock Exchange 150 years ago. And what happened was, because of the nature of the risk, we regulated it. We did it for bonds. We called them securities now. Back then, they were speculations, no different than this nascent industry. The reason this is happening over and over again, and we'll be back here again soon when the next one blows up, is the lack of regulation. That's why we regulate stocks and bonds. They are speculations too. You speculate the profits of the companies underlying those securities. We need to regulate this. I mean, this premise that it's some kind of different issue, it's not. It's just unregulated Wild West, and it will go on and on and on. It's the definition of madness, is expecting a different outcome. I mean, that's just, it needs regulation. That's it.
I take it that's a yes, that there should be strong rules addressing related party transactions and creating firewalls.
A long yes.
Okay, a long yes. Ms. Schulp?
I also have a longer answer, but I'll still keep it short. I do think that conflicts of interest are something that need to be examined and addressed, whether that results in strong rules banning certain types of transactions or whether it is simply that disclosures must be made is a different question. So while I agree that there are potential issues there, I'm not sure I will agree with the outcome that you're looking for, Mr. Brown.
Thank you. Mr. Schenken?
Yes.
Thank you. Senator Toomey.
Thanks, Mr. Chairman. Let me start with Ms. Schulp. Mr. Schenkman indicated his opinion that I think he said every cryptocurrency, or virtually every one, easily meets the Howey test for the definition of a security. The Howey test includes the investment of money in a common enterprise with the expectation of profit through the efforts of others. So in Bitcoin, we have no corporation that controls it or issued it. We have no individual. We have no committee. It seems to me purely decentralized. Isn't it hard to establish that there's a common enterprise when there is no central authority that controls and operates it?
I agree. I don't think for Bitcoin you can meet the elements of the Howey test in multiple respects.
Right. So, would you say, as a general matter, a truly decentralized protocol, it's pretty hard to establish the common enterprise?
I completely agree. The securities laws were evolved in no small part in order to deal with questions of information asymmetry coming from managerial bodies that are doing that.
Right. Where is that asymmetry? Look, I think there's a case to be made that there should be a regulatory regime on disclosure requirements for an issuer, that there should be a regulatory regime for secondary market trading, but I think we ought to make it specific to this sector, because to try to shoehorn it into decades-old legislation that deals with different instruments, I think is very problematic. Mr. O'Leary, it seems to me that tokens are very often the tool or mechanism to incentivize people to validate and maintain a distributed ledger. Now, you can gamble with them. You can speculate as to what a given token is going to be worth. But it seems to me that underlying blockchain technology is potentially extremely powerful, is actually already being used in a variety of ways. Could you address this notion that the only possible use is a zero-sum gambling enterprise?
No, I don't agree with that at all. It's preposterous to say that. The potential of blockchain technology in authenticating physical assets and contracts and tokens, as you suggest, is incredibly powerful. In fact, I think what's going to happen as we peel the onion on FTX over the next year or two is the shining outcome of the success of the blockchain to track these assets will become the focus of everybody. We will realize every security or token that left FTX, left Alameda, got traded between shareholders, all tracked irrefutably on the blockchain. The power of this technology is very harnessable, very powerful, and of course, we should lead the world in it because so much of it is developed here. The hottest hands coming out of MIT right now, where do they want to work? A third of the class. They want to work on the blockchain. You can't take that much potential and not expect extraordinary outcomes. This is a remarkable technology. Yes, it requires regulation, but if you just ask where the hot hands are going, the great engineers, this is where they're going. So, we train them here, and then we kick them out of the country so they do their work somewhere else.
So let me ask you directly. You were an investor in FTX, and I know you've spoken frequently with Sam Bankman-Fried over an extended period of time. Why do you believe FTX failed?
I have an opinion. I don't have the records. Here it is. After my accounts were stripped of all of their assets and all of the accounting and trade information, I couldn't get answers from any of the executives in the firm, so I simply called Sam Bankman-Fried and said, "Where is the money, Sam?" He said he had been refused access to the servers. He no longer knew. I said, "Okay, let's step back. This is a simple case in my mind of where did the money go?" And I said, "Sam, walk me back 24 months. Tell me the use of proceeds of the assets of your company. Where did you spend it?" And then he told me about a transaction that occurred over the last 24 months, the repurchase of his shares from Binance, his competitor. I didn't know this at the time, but at some point, CZ or Binance, who runs Binance, purchased 20% ownership in Sam Bankman-Fried's firm for seed stock. And then, over time, and I asked him, what would compel you to spend $2 billion was the number he was giving me at that time. Later, in a subsequent conversation, about 24 hours later, he told me it could have been as much as $3 billion to buy back the shares from CZ. I asked him, what would compel you to do that? Why wouldn't you keep your assets on your balance sheet? And why would you offer this to just one shareholder? He said, because every time we went to get licensed in different jurisdictions, because you must understand the prize of crypto is to get regulated. For all the talk we say about Bitcoin and everything else, no institutions own this. I work for the sovereign wealth and pension plans. They don't touch this stuff because it's unregulated. Between these two, let's call them frenemies, because they obviously were potentially the two largest shareholders in the firm, they had a disagreement. They had a falling apart. Apparently, according to Sam Bankman-Fried, CZ would not comply with the regulators' request in these different geographies, these different jurisdictions, to provide the data that would clear them for a license. He withheld it, according to Sam Bankman-Fried. The only option the management and Sam Bankman-Fried had was to buy him out at an extraordinary valuation of close to $32 billion, less apparently a 15% discount. That stripped the balance sheet of assets. You ask me why it went bankrupt? Go to the last week. All of a sudden, in social media, CZ is asking for another $500 million. He wants to do a block trade of FTT, or the proprietary token of FTX. Wants it converted back to fiat. Why would you put that out there? You know it's going to push down the pressure. It's going to push down the value of that coin dramatically, and that's exactly what happened. Every trader knows that if you have a large block trade, you go negotiate a clearing price with other buyers and you do the transaction. In my view, my personal opinion, these two behemoths that own the unregulated market together and grew these incredible businesses in terms of growth were at war with each other. And one put the other out of business intentionally. Now, maybe there's nothing wrong with that. Maybe there's nothing wrong with love and war. But Binance is a massive, unregulated, global monopoly now. They put FTX out of business. Now, lots of other reasons, I'm sure, but that's my personal opinion. That is what Sam Bankman-Fried told me in terms of where the assets went. Why should we care? Single reason. I'm a shareholder. You tell me the two largest shareholders do a transaction together, that's a related party transaction. I'm not sure that's okay. Maybe I want a Madoff clawback on those proceeds. Maybe I want to pursue that.
Mr. O'Leary, I'm sorry, you're about 3 minutes over. You have any follow-up, Senator Toomey?
I had another topic, so if we do a second round, I'll take it up then. Thank you, Mr.
Thank you. Senator Reid of Rhode Island.
Well, thank you very much, Mr. Chairman, and thank you, panel, for your insights. The restructuring officer, John Ray, described in detail the absence of audited or reliable financial statements, absolutely no internal controls. Professor Allen, I'd like to ask a few questions about FTX and how they were able to get away with essentially cooking the books. First, was FTX a publicly traded company?
No.
No. As a private company, was FTX required by law to disclose basic information to the public about its business, like audited financial statements?
No.
Was FTX required to disclose transactions with related parties, like Mr. Bankman-Fried's hedge fund called Alameda Research?
No.
And also Mr. O'Leary's example, that would be required to be disclosed. Was FTX required to have a chief financial officer or disclose whether a financial expert was on the board of directors?
No.
Was FTX auditor required to attest to the effectiveness of the company's internal and corporate controls?
No.
And if FTX had been a publicly traded company, would it have been required to make the disclosures and attestations that we've just discussed?
Sorry, I missed that question.
If FTX had been a publicly traded company, would it have been required to make the disclosures and attestations that we've just discussed?
Yes.
Okay. Thank you very much. And it's just not that FTX is a private company. In fact, just about all the biggest companies in the crypto industry are also privately held. In September, I introduced S4857, the Private Markets Transparency and Accountability Act, which would require the nation's biggest private companies, including FTX, to disclose basic information about their financial condition and comply with basic corporate governance requirements. And according to a letter from the North American Securities Administration, this legislation, in their words, would have made it easier for all of us to spot or prevent the alleged fraud and other misconduct at FTX earlier. So, Mr. Chairman, I would ask unanimous consent to include this letter in the record.
Without objection, so ordered.
Yeah. The whole point is that we've all talked about the need for regulation, and I think that's obvious. And we have many mechanisms pending here in the Senate and the House to do that. We just have to move quickly. I would suggest this is a good place to start. And a final question, Professor Allen, do you think that would have helped illuminate what was going on at FTX?
Yes, I think so. I mean, attestations and proof of reserves and other forms of accounting disclosures common in the crypto industry, they don't include the rigor, the independence, and the professional skepticism we get from auditors. But I would note that we should be wary of FASB's moves to implement fair value accounting for crypto assets, because accepting market valuations from the crypto industry could potentially undermine the value of the audit function, and that's something to be wary of.
Thank you very, very much. When we talk about crypto tokens, in fact, it's reported that FTX held about $900 million in liquid assets and $9 billion in liabilities when it failed. And the vast majority of FTX assets were illiquid cryptocurrencies created and promoted by FTX and Alameda. And the company held them at wildly optimistic valuations that turned out to bear little resemblance to reality. Can you explain how aggressive valuation practices contributed to the failure of FTX and put customers at risk, Professor?
Sure. As I outlined in my written testimony, many crypto assets are created out of thin air, and there's no real basis for their valuation. There's simply no way to perform a sanity check on the valuations that are provided, as those assets trade entirely on sentiment. And so when assets trade entirely on sentiment, meaning what other people think they're worth, that creates a space where a significant amount of leverage can be created and fraud can easily go undetected.
Thank you very much. Again, I think the one theme that seems to be consistent is that the need to regulate not just this industry, but private entities that are controlling a huge amount of funds that are investing in ways that are not obvious to the public or even to their own shareholders or equity owners. And we have to move, and I would suggest as a starting place, the legislation I've proposed. Thank you, Mr. Chairman.
Thank you, Senator Reed. Senator Menendez of New Jersey is recognized.
Thank you, Mr. Chairman. A lot of securities regulation essentially comes down to one thing: what actions are and are not permissible when one person is handling another person's money. And by and large, we in Congress, the securities industry, and the general public have agreed on the major principles that should guide that activity. For instance, as you point out in your testimony, Professor Allen, brokers are not permitted to use customer funds to finance their business. They are required to fully disclose conflicts of interest. And when dealing with retail investors, they are required to go further and mitigate certain conflicts. FTX didn't seem to have done any of this, and if they had, it seems like a lot of harm would have been prevented. So, Professor Allen, is there any reason why we shouldn't apply the same broad regulatory principles that are now in place with the traditional financial sector to digital assets?
I see no reason. The reason we typically hear is that crypto is different because it's decentralized, but in fact, it's not decentralized. At every level, there are people controlling things. So, we heard that that Bitcoin was decentralized. Well, Bitcoin is controlled by a few core software developers, fewer than 10, and they can make changes to the software, and then that software is implemented by mining pools, and there are just a few of them. So in all these spaces, there are definitely people, often a very few people, pulling the strings, but the fact of the matter is that they are unidentified and unregulated, and that is not an ideal space to be in.
Yeah. Mr. O'Leary, in your testimony, you said you hope that the events at FTX would, quote, put renewed focus on implementing domestic regulation. Do you agree that FTX customers and perhaps your own investments would have been better off if FTX had complied with the existing regulation we have that bars brokers from trading with customer funds?
Absolutely. But they were not compelled to do that because they were offshore and unregulated. I think the model will not work. There's examples of how regulated exchanges that are attached to broker-dealers have worked. You only have to look up to Canada, the OSC order, where BitBuy wallets are controlled by the regulator. They limit the number of tokens. They limit the margin. They limit the lending. They do an exhaustive test of proof of reserves. And that's just the rules they implemented that they just copied from their own exchanges. Right. We need to do the same thing here. It works. It's been proven to work. There's millions of Canadians that have accounts that are working under a very strict regulatory environment. We can implement the same.
Well, I agree. We already know what should and should not be allowed when one person is handling another person's money. Whether we're talking about a new celebrity-endorsed coin or an index fund, I think we'd be well served to keep in mind the basic principles that have largely saved and served investors and the markets well for decades. As I was listening to some of your testimony back in my office, it all seems like you looked at this as more of a security than a currency at the end of the day, and that makes it pretty clear for me. In the wake of FTX collapse, many crypto firms have attempted to reassure the public of their soundness by hiring outside auditors to provide proofs of reserve. However, the quality of these audits are inconsistent and oftentimes provide an incomplete picture of the company's assets and liabilities. Professor Allen, can you explain some of the flaws in these reports and why they are not as helpful to investors as the crypto industry claims?
Well, I mean, there is the fundamental issue that where do you even get the valuation number from these assets? Do we treat them on a sort of a fair value accounting basis? If so, we're essentially accepting whatever the market says about these asset prices, and then they're entirely based on sentiment. So, in addition, even if we put that aside, the actual attestations, et cetera, that we're getting, as I said, they don't have this skepticism that we expect from professional auditors who look at the financial statements to find red flags. They're required to look for red flags. In these attestations and proof of reserves, it's basically just the accountants sort of reporting what they've been told by the industry.
No. One of the things I'm concerned about is the extent that cryptocurrency becomes integrated with the financial system, and therefore the risk to the financial system, which up to now has been pretty stable. And that is something I'm concerned about. Let me close on this. Prior to its collapse, FTX was well known for huge spending on celebrity endorsements. Dozens of sports stars, actors received millions of dollars to generate hype for FTX and assure the public that crypto was a safe investment. There have even been reports that FTX was pursuing a $100 million sponsorship deal with Taylor Swift earlier this year, even as the as the firm was hemorrhaging money. So FTX isn't the only firm doing this. Endorsements from public figures are just one of the factors contributing to misinformation about crypto. Mr. Shanken, how can we combat the spread of crypto disinformation and encourage investor education?
Use words that are accurate. The cryptocurrencies are not currencies. We need to classify them as securities properly. I also think that we should consider treating crypto like gambling and having potential limitations on advertising and disclosures.
Thank you, Mr. Chairman.
Thank you, Senator. Senator Tester from Montana is recognized.
Yeah, I want to thank the chairman and ranking member for having this hearing, and I want to thank the folks who testified today for being here to testify. I appreciate it. I am concerned that we're signaling to people that this is a credible and sound investment. But as we've seen lately, there are clearly bad actors. Crypto has been peddled everywhere from the internet to the Super Bowl as get-rich schemes or safe places to put your retirement savings. But things look pretty uncertain right now, and that's a best-case scenario. Ultimately, I want to make sure the taxpayers aren't left holding the bag. These may be interesting technologies, but I've yet to see how it can be useful in a real world without substantial risk to for Americans. I'm skeptical, but I'm here to hear from both you, the proponents and opponents, and that's why I'm glad you're all here today. Professor Allen, when you were in front of this committee about a year ago today, as a matter of fact.
Exactly.
You discussed similarities with synthetic products, and you highlighted concerns that, unlike 2007, these products are targeted at institutions and individuals. As we've seen larger and larger issues play out in this industry over the past year, how has your concern that you expressed a year ago played out?
So in some ways, I've been heartened by the fact that the banking regulators have really kept this stuff out of the banking system, and I think that's why we're talking about the investors of FTX being harmed rather than everybody being harmed. But still, I mean, I think the idea that crypto is trying to disrupt banking is inaccurate. Crypto and banking would love to merge, and it's the regulators that are keeping them apart. And so as we look at the banking industry trying to dip their toes into this water, I think there are a few causes for concern. Bank of New York Mellon is custodying crypto. JP Morgan is doing trades on permissionless blockchains. So I think we need to firm up this separation between crypto and banking in order to protect the broader financial system. But as I said, I think banking regulation has held up pretty well so far.
For you again, Professor Allen, the new bankruptcy-appointed FTX CEO has warned that the U.S. entity is not solvent. American customer accounts are in doubt. What does this mean for the consumers who are utilizing FTX?
Well, in the short term, it means that they are not going to be able to access their funds because they're tied up. In the long term, it means that they may not have any funds. So that is, I mean, really devastating. And we have to think about how much of this we're willing to tolerate in the name of innovation. This is not a great innovation. I would point out that the Australian Stock Exchange spent years trying to use blockchain technology to restructure it, and it's just given up entirely because the technology was not fit for purpose. I think we need to think really hard about the costs of what's going on.
So could you tell me what this could have meant for taxpayers if legislators had gone further with blessing this industry?
Sure. The size of the subprime mortgage market in 2007 was estimated to, and I don't have my figures here, but I think it was about 1.3 trillion. And we've just talked about a crypto industry, and as I said, the valuations are crazy in crypto, but we've talked about an industry that's shrunk, apparently from 3 trillion to under 1 trillion. So if that amount of assets or exposure had been brought into the existing financial system, intertwined with our existing financial system, then the banks would have been in a very serious problem. They wouldn't have been able to lend. They would potentially not be able to process payments. All the things that we count on for our broader economic growth would be jeopardized.
Do you think there would have been an inherent response that would have required Congress to step in and bail out folks, like happened in 2008?
Absolutely. It's simply untenable to let the economy tank like that. I mean, that's just the fact of the matter. And so that's why I think it's so critical that crypto be segregated away from banking. We do not want to make it too big to fail. It's too big to fail is problematic with any asset class. An asset that has no productive capacity, that doesn't serve any capital formation function, that just is crazy.
Mr. O'Leary, in one of the answers to one of the other senators' questions, you said that the prize for crypto is to get regulated. Is that because it gives it credibility?
It can't exist for the institutional client. The potential of crypto is for it to be indexed with sovereign wealth and pension, where about 70% of the world's wealth is actually managed. There's great interest there, particularly around Bitcoin and Ethereum and a few other platforms, but they have no infrastructure to apply to their compliance platforms. When you are managing a $900 billion fund, every day you have a massive compliant infrastructure that marks to market all your positions. There is no infrastructure for crypto. I want to make a note here just around this regulatory issue that you're raising, and it's a good one. Of all the entities that went to zero, that went to bankruptcy in the FTX portfolio, the only one that is not bankrupt out of the 130 plus, and this is, probably the best evidence of why we need regulation, is Ledger X. Why? It's regulated by the CFTC. 100% regulated. It is not bankrupt. Had the other entities been regulated wherever they were, they would too not be bankrupt. And so just look at this. This is a use case of why we need regulation. There wouldn't be this tragedy and all of this drama and all the rest of this stuff and the loss of billions of dollars. The lack of regulation has caused some problems here, and it will continue to. And the evidence is right here. The only entity that didn't go to zero in the FTX portfolio, CFTC, forced the scrutiny, forced the transparency, forced the proof of where the assets were held and the reserves, forced the lack of commingling with the assets. They forced it. They did it. Proof positive that you can regulate this asset class.
I want to thank you all for being here today. We'll have some questions for the record, but I appreciate the hearing, Mr. Chairman.
Thanks, Senator Chester. Senator Haggerty of Tennessee is recognized.
Thank you, Mr. Chairman. Ranking Member Toomey, thank you for holding this hearing. To all of our guests here today, I appreciate your being here. I'd like to touch on something that has been troubling me for some time. We know that FTX's collapse as the second largest exchange is continuing to have ripple effects throughout the entire digital asset industry. But if you look back to even early November, FTX didn't appear to have the necessary scale to cause an industry-wide systemic meltdown. Binance, on the other hand, is the largest global crypto exchange, nearly 7 times larger than FTX by trading volume. At least it was in the month leading up to FTX's collapse. And Binance's market share, now with the absence of FTX, I think means it will only grow. If you think about a similar implosion by Binance, that would really prove catastrophic. It would prove catastrophic for the cryptocurrency industry, and it would prove catastrophic to all of the consumers that utilize the industry. Yet U.S. regulators are limited in the extent to which they can mandate appropriate audits or appropriate disclosure of Binance's operations. Unlike the requirements placed on companies which are publicly traded here in the United States, Binance operates outside of our system. So, Ms. Shope, I'd like to start with you. How can U.S. regulators work with their global counterparts to bring transparency to Binance's activities and to understand the reserves that it holds?
I think you raise a very important point that when we talk about FTX or we talk about Binance, so much of what we're talking about is happening outside of our shores. And the influence that U.S. regulation can have on those exchanges and other crypto projects that are not taking place here is limited. I think it's very important to have an ongoing dialogue with international regulators in order to have influence where we can. But I think the most important thing for the United States to do is to create a rational crypto regulatory framework in the United States to try to bring some of that home so that we have maximum influence over how those businesses are operated.
I hear you, Mr. O'Leary, you touched on this just a moment ago about the impact of regulation and the certainty that it could bring. And from your perspective as an investor, Mr. O'Leary, what needs to change here in Washington from a regulatory standpoint so that capital actually does flow to U.S.-based entities and empower U.S.-based entities to win on the global stage?
Every global platform, the #1 prize is to be regulated in the U.S. market, the #1 financial market on earth, period. Now, when you talk about other money center banks or other financial services industries that want to do business in the U.S., they must disclose their worldwide operations. They are scrutinized by the rules we already have in place. A coordinated effort between the Canadian regulator, the U.S. regulator, the ADGM in Abu Dhabi, the regulators in Singapore, basically laying out the ground rules for any entity that wishes to do business in the U.S. or any of those jurisdictions solves this problem. If Binance is not willing to, and you started by talking about them, disclose, and the reason that Sam Bankman-Fried claims he spent $3 billion was that he could not get the regulators to approve the fact that Binance owned 20% of their platform. CZ was not cooperative with any of those regulators. He was shut out of those markets, and he realized the prize was to get regulated for institutional capital. Just having 4 or 5 markets coordinate, as we do already in other securities, solves this problem in perpetuity. And it's all these regulators talk to each other. I've been to Abu Dhabi. I've talked to the ADGM. I seek a license there. And I've done the same in Canada. I'm an investor in the license there. These are long-term, very sound structural concepts, but it needs a coordination. And in one phone call, we could solve this problem.
I'm going to come back to you, Ms. Schulp, for a moment. And I want to stay on this concern that I have, particularly about Binance, about the Chinese Communist Party's role in support of that. To be clear, Binance is being proliferated around the world. It's a state-backed network. They're proliferating in emerging markets in a very predatory fashion. They're in developed markets. And again, now they have an even more open platform as FTX has been taken down. But if you think about an example like Binance with ties to the CCP, a committed partner to the Belt and Road Initiative, and particularly as it expands its market dominance with the collapse of FTX, what does that spell if lawmakers here in America follow through with their threats to ban digital assets or leave the current regulatory uncertainty in place? What does it mean for the global crypto market in general? What does it mean for our nation's national security and our economic security? And most important, what does it spell for the dominance of the U.S. dollar as the world's reserve currency?
Regardless of whether Binance itself is connected with the Chinese Communist Party, which Binance denies, but regardless of whether that's the case, by having a system in the United States that's unclear, that's regulatorily hostile, that could go so far as banning cryptocurrency in the United States, we would be losing the position of having the possibility to maintain American dominance for these technological innovations.
I'm deeply concerned about that.
We would also be losing many of the great minds that want to work on these types of projects that can make strides not just in blockchain and cryptocurrency, but in other technological functions as well. To the extent that the United States is not a place that people look to for economic development, that also puts the U.S. dollar at risk.
Thank you. Thank you, Mr. Chairman.
Thanks, Senator Hagerty. Senator Warren of Virginia is recognized. Senator Warner of Virginia is recognized.
Thank you, Mr. Chairman, and appreciate you holding this hearing. I want to echo some of the concerns my friend from Tennessee just echoed about Binance. I do think it's curious that China has made the decision to basically take that kind of risk to ban crypto because of their at least risk-reward analysis. I got so many questions. I do think I know a lot of this started around Bitcoin. I still think, and I think, Professor Allen, you may have touched on this in your testimony, the clunkiness of the technology behind Bitcoin. I mean, it could never go to scale no matter what. If you can only do 5 or 6 transactions per second, that is not a scalable tool. And obviously, at technology, at a power and environmental costs, that just doesn't make sense to me. But I'm going to try to get as quick as I can in my 4 minutes. I'm going to start with Professor Allen and Mr. McKenzie. I sometimes worry that FTX is just the tip of the iceberg. I'm sure many of my colleagues have gone through all the bad things Bankman-Fried has done, and the graft, and the Ponzi schemes, and so forth. And I know Senator Haggerty already made comments about the Reuters story about Binance. I really worry. I mean, I know the original pitch was, this is going to be a seamless ability to transact without currency risk, without timing risk. I can send my grandmother in Kenya, resources on Sunday in a way that's kind of error-free. Sitting where I do on the Intelligence Committee as chairman, we've seen virtually no examples of that kind of use case. I know, Mr. McKenzie, you've gone down to El Salvador where they tried to make that as the case. It just doesn't seem to be the case. Instead, we are seeing, at least at this date, and Senator Almas has been a leader on this. I keep trying to have an open mind on the technology innovation, and I'm all in on technology innovation. But at least so far, from where I sit on the Intelligence Committee, I see an awful lot of illegal activity. I see drug deals. I see bad actors. I see ransomware criminals. And frankly, it's not even safe from them. Go back to the Colonial Pipeline issue, where our government, when payment was made in crypto, was able to recover some of that. So I guess I'd start again with Professor Allen and Mr. McKenzie. Do you think FTX is a one-off, or is this the tip of the iceberg where we may be seeing a whole series of activities? And if you want to go ahead and I know it's been raised, but I don't think it in any detail, Alameda Research and some of the potential, I think we're only beginning to see the conflicts that were taking place there. But I'll start with Professor Allen and Mr. McKenzie.
I think we saw the tip of the iceberg a couple of months ago, and then this is sort of moving further down the iceberg, with the earlier rounds of Terra Luna and Celsius. The concern is that, that fraud is definitely being perpetuated, but that the whole industry itself is basically an asset class built out of nothing. It trades entirely based on people's belief that it can be worth something. But as he said, the technology has not worked for a payments mechanism. It's become a speculative instrument, but ultimately, as Mr. McKenzie said, it's a zero-sum game, and if people stop believing in it, then it all falls apart. So Mr. O'Leary has talked about how people, that regulation in the United States is the prize. That's exactly right. Without that regulation as the prize to legitimize crypto, there is nothing there, and it could all go to zero. And whilst that is very bad news for the people who've already invested, I think it's very good news for the rest of us because it's being kept out of the broader financial system, and we won't suffer the consequences from its broader failure.
Mr. McKenzie?
Thank you, Senator. Yes, I just want to echo what Professor Allen was saying. One of the many, many seemingly limitless ironies of cryptocurrency is that the supposedly decentralized nature of it it's in fact highly centralized. I know this. I wrote an article with my colleague Jacob Silverman for the Washington Post about Binance this spring. Binance is incredibly murky, but Binance, as Mr. O'Leary, as other senators have pointed out, Binance is in communication with FTX. They were an early investor in FTX. There was apparently there's a private Signal chat group entitled Exchange Coordination that CZ is on. Yes, this is publicly reported. I believe Mr. Bankman-Fried submitted it into the congressional record, if if I'm not, yeah. And so they're all talking to each other. The crypto industry is actually really, really small amongst the people that count. In a zero-sum, strictly competitive game, there's winners and losers. In an unregulated zero-sum, strictly competitive game, you're either a scammer or a mark. If you don't know which one you are, you have a problem. Oh, do you want me to answer the remittances question? I'm sorry, sir.
Well, if you want to just touch on Alameda as well.
Sure. So Alameda is Tether's biggest client. That's according to reporting from Protos from last year. Supposedly, Alameda purchased, I believe, $36.7 billion worth of tethers. Given Alameda, FTX's insolvency, I think one question might be, where'd the money come from?
Yeah. Let me just, I know my time, but Mr. O'Leary, I have a great respect for you as an entrepreneur. Spent a long time as an entrepreneur. I'm trying to sort this through as well. I get your point, but I guess what I'd raise for the chairman and the ranking member is, I'm still trying to wrestle with this in my mind, whether we need a crypto set of rules or whether we frankly, what are we, 14 years after Dodd-Frank, ought to take a bigger step backwards and realize we got this bright, shiny problem over here around crypto, but the amount of financial activity, you look at the fact that over 50% of the mortgage origination now is outside the regulated banking sector. I've been a big advocate for fintech for a long time, but there are a whole series of lending entities out there, again, that have no regulatory protections around them at all, and nothing would be worse than doing a relatively good job. We may overdid in certain parts on Dodd-Frank, but put a structure around our regulated industry and suddenly see this huge escape of financial activity going outside any kind of regulatory envelope at all. I'm all for innovation, but Lord knows if crypto was suddenly followed by a whole series of fintech entities that were coming back saying, hey, I need my money back as well. I didn't get my lending that was taking place on this platform. We could have a problem. Thank you, Mr. Chairman.
Senator Lummis of Wyoming is recognized.
Thank you, Mr. Chairman. I also want to thank Senator Toomey for his wonderful leadership on this committee, just in the event this is our last hearing. Thank you for your service.
Hearing tomorrow.
We're conflating topics today. Digital assets are not on trial. Fraud and organizations are on trial. So let's separate digital assets from corrupt organizations. FTX, as I've been saying for the last few weeks, is good old-fashioned fraud. And what they did is separate from digital assets. Now, we've all heard that FTX lent its executives hundreds of millions of dollars in commingled customer funds for personal use, and customers who tried to wire money to FTX were instead given Alameda's routing number. That is fraud. That's fraud whether it's conducted in US dollars or euros or digital assets. That is fraud. Additionally, even though FTX was a multi-billion-dollar enterprise, it had a shocking lack of corporate controls and enabled affiliates to conceal the movement of money and take on enormous liabilities, enabling the they misused customer assets that were supposed to be appropriately safeguarded. FTX, in its terms of service, said, title to customer digital assets always remain with the customer. Now that we know is a lie, and now millions of FTX customers around the world will suffer. So FTX is a failure of people, safeguards, and regulation. It's not a failure of technology. The people of the digital asset industry need to get really serious about risk management and compliance with things like anti-money laundering laws, and that's why we've seen a failure of a number of firms engaged in riskier practices, even for the digital markets this year. So one question people should ask themselves is how FTX grew so quickly. They were founded in 2019 and grew to be one of the largest digital asset exchanges in just 2 years. So you look at other companies like Kraken, Coinbase, and Bitstamp, they've been around for a decade. They've grown organically. This committee needs to be focused on putting legislative solutions in place that would have prevented FTX's collapse and other firms like it. This means things like regulation of digital asset trading, providing consumers with adequate bankruptcy protection, disclosures, and stablecoin regulation. So let's not conflate topics here. Mismanagement, failure of people, inadequate controls is what's on trial. We need to regulate this business and lay digital assets on top of our existing financial regulatory framework. Questions? Ms. Schulp, why do digital assets and distributed ledger technology have the power to make our capital markets safer and more efficient?
Well, there's multiple ways that they can do that, and one of them is by removing the intermediaries that we've been talking about, where there are potential for such things as an FTX to take customer assets and misuse them. When those intermediaries don't exist in digital asset systems, then you don't have the same risks. You can also have faster, cheaper payment systems than we currently have, and more global payment systems which allow people to send money cross-border in a way that should be very important for a country like the United States, which sends a lot of remittances across the world.
I know I'm out of time, but I want to make a plug for the Responsible Financial Innovation Act that Senator Gillibrand and I have co-sponsored, that we've been talking to our colleagues about. This is a case study in why we need the Responsible Financial Innovation Act. We will be reintroducing the bill next year. We're absolutely delighted and willing to take your comments, suggestions, ideas, and it's time to move. Time to move to regulate the digital asset industry. Thank you.
Thanks, Senator Lemons. Senator Warren of Massachusetts is recognized.
Thank you, Mr. Chairman. So Sam Bankman-Fried and other crypto billionaires argue crypto is special, but a basic principle of our financial system is same kind of transactions, same kind of risk, means same rules apply. Right now, if a bank takes money from terrorists, and the bank and the banker then have broken the law. And that's why banks spend so much time and so much energy identifying who their customers are and reporting suspicious activity to authorities. A lot of crypto firms are not doing these kinds of checks. So crypto has become the preferred tool for terrorists, for ransomware gangs, for drug dealers, and for rogue states that want to launder money. In 2021, at least $14 billion in digital assets went to criminals. Now, that's a lot of drugs and a lot of ransoms and a lot of bombs and a lot of nuclear materials, but it is likely only the tip of the iceberg. A new report finds that one crypto exchange alone helped launder over $10 billion for criminals and countries like Iran. Even so, the crypto industry continues to take the position nothing should change. Professor Allen, the crypto industry claims that it doesn't need to do all of the know your customer and other anti-money laundering checks that banks do and stockbrokers do and even Western Union does, because crypto is uniquely transparent. Everything is on the blockchain, so criminals and rogue states that try to launder money in crypto will quickly be found out. Does the fact that the blockchain is public mean that it is more difficult for criminals to launder money using crypto?
In many ways, the blockchain is the worst of all worlds. For everyday people, the blockchain is a permanent public record of all their transactions, which is a privacy nightmare. But for sophisticated players with a vested interest in hiding their transactions, there are all kinds of tools available, mixers, tumblers, et cetera, that can hide the provenance of their crypto assets. And far from being difficult for criminals to use crypto to launder money, the fact that there aren't KYC checks is the point.
Okay, so crypto is actually easier to do money laundering. Let's look at another crypto industry argument. Professor Allen, the crypto industry claims that it would be too much trouble and maybe even technologically impossible for them to check customers the way that banks and stockbrokers and even Western Union does. But let me ask, do banks and stockbrokers in Western Union have to invest money and resources to make sure that they're set up to conduct those checks?
Yeah, I mean, KYC requirements are simply part of operating a financial services business. But avoiding those requirements, as you say, is critical to many crypto business models. Blockchain-based transaction processing, as we've discussed, is very clunky and expensive. Ms. Schulp has just told us that it can be more efficient. The only way it's more efficient is if it actually avoids the KYC checks that can slow things down. So this crypto business model is in many ways a regulatory arbitrage play.
Right. So actually, it's an interesting question. If banks and Western Union said they shouldn't have to follow anti-money laundering rules so that they could make more money, they could improve their profitability, what would our country say, and what does every country around the world in the financial system say?
No.
Right. Okay. So, Mr. O'Leary, I know that you are a big supporter of crypto, even after you lost $10 million in FTX's collapse. But you are an experienced investor. So let me ask you, do you believe that the potential benefits of crypto are so promising that we should accept weaker anti-money laundering rules and weaker compliance from crypto firms than we require from banks, from brokers, and from Western Union?
No, I think we should apply the same regulatory structure that we apply to existing trading of stocks and bonds on exchanges tied to broker-dealers. That is not complicated. It's already been implemented in other countries. And so, and I take issue, Senator, with your concept that it makes it easier to do money laundering. Currencies have been used for drug trafficking since the 60s in the American dollar, when it was thrown out of a Piper aircraft in a duffel bag. The American dollar is also used by bad actors all the time.
Mr. O'Leary, I appreciate your point that everyone tries to engage in money laundering. That's what terrorists do. That's what drug dealers do. And that's what states like Iran and North Korea have done. The only point I'm trying to make is, should the same rules against money laundering apply to crypto in the way that they apply to banks, to stockbrokers, to credit card companies, to Western Union? And I think your answer to that was yes. Is that right?
No.
Mr. O'Leary, you have 30 seconds. Keep your answer short.
It's not yes. I'm just saying, if you know your client rules on both sides of the transaction and use a crypto such as USDC that is regulated, you solve this problem, Senator, overnight.
Well, I appreciate that you want the same kind of rules to apply to everyone, and we can talk about what's needed to make that happen. You know, the dark underbelly of crypto is its critical link to financing terrorism and human trafficking and drug dealing and helping rogue nations like North Korea and Iran. Crypto doesn't get a pass to help the world's worst criminals, no matter how many television ads they run or how many political contributions they make. It is time for Congress to make the crypto industry follow the same money laundering rules as everyone else. That is why Senator Marshall and I introduced a bipartisan bill today that requires crypto to follow the same money laundering rules that every bank, every broker, and Western Union all have to follow today. Thank you, Mr. Chairman.
Senator Van Hollen of Maryland is recognized.
Thank you, Mr. Chairman, and let me add my words of appreciation to Senator Toomey for his leadership on all sorts of issues. I've disagreed with Senator Toomey many, many times, but I've also had the opportunity to work with him closely on lots of issues. So, Pat, thank you. And thank all of you for being here. You know, over the last more than 2 years, I think this committee has been trying to take a crash course on crypto and understand all its implications. And I think the fact that we have 4 very bright individuals here with
diametrically opposed views is an illustration of the challenges we're facing as a committee. But I do want to pick up where my colleague, Senator Tester, did. Because the question is, where do we go from here? And on the one hand, the impulse is, of course, to want to protect consumers. On the other hand, we want to make sure that in the process of trying to do that, we don't give a government imprimatur to a system that is so inherently risky and without necessarily any, as at least two of our witnesses said, underlying value. So, Professor Allen, if you were king, queen for the day, what would you do right now? And let me just say, we've got the SEC. The SEC clearly has the authority and power to go after fraud, and we need to make sure they have the resources to go after fraud in this area because it's grown very fast. But beyond using the existing tools, what would you do going forward?
If I were queen for a day, I would ban it. But if I were someone who was dealing with multiple constituencies and realized that that might not be viable, I think the path I would take would be to strengthen banking law, what I've been calling Glass-Steagall 2.0, and make it quite clear that banks simply may not touch crypto in any way, shape, or form. And then I would give the SEC more money. I would pass legislation that makes it clear, abundantly clear, that all crypto is a security. And to be clear, the definition section in the securities legislation doesn't just list investment contract. This isn't just about the Howey test. There's all kinds of securities that don't go through the Howey test. Bonds are just listed. If it's a bond, it's a security. So we could say, if this is a crypto asset, it's just a security. You don't have to go through the Howey test framework. And then we apply all the securities laws robustly, and I think that is the best way forward.
Thank you. And is it Mr. Shanken, Mackenzie Shanken?
Yes, sir. You can also call me Ryan Atwood from the
All
OC.
right. All right. Well, in that case, listen. Let me appreciate your testimony. The bottom line, as I understood, is you said we should just deal with this and regulate it like it's gambling. And I've been listening. I've been listening to analogies to Enron. I've been even analogies to the mortgage meltdown, mortgage-backed security meltdown. At least in those cases, they're backed by real assets, right? In the case of Enron, you've got an energy-producing company. In the case of mortgage-backed securities, it was an outrageous scandal. At the end, there was some, it was supposed to be backed by real houses. What is this backed by, if I could ask you? What is this backed by at the end of the day?
Nothing. It's a story. Robert Shiller, the Nobel Prize-winning economist, talks about how economic narratives form. They're in response to real events. In this case, with cryptocurrency, I would argue the genesis was the subprime crisis. The Bitcoin white paper, released in October of 2008, was perhaps well-intentioned. It was intended to be a peer-to-peer currency that would avoid all intermediaries. So the story has understandable appeal. I think if crypto serves any function, it's to highlight the myriad failures of our regulated system and our banking system and our American economic system to provide people with a fair shot at the American dream, or what's left of it. That does not make the story true, however, the story of cryptocurrency. What it does is lend it enormous power. And these stories spread, as Shiller describes, like viruses, infecting one person to another, much like a multi-level marketing scheme. But for the digital era, instead of a 5-hour Tupperware party, you get a 60-second TikTok video. And you're encouraged to invest because you see other people investing. They call it FOMO, fear of missing out. We used to call it greed. People get very excited. These bubbles build up very big, but then they collapse very swiftly. And I think that's what we're seeing now today.
Thank you. Thank you all.
Thanks,
Thank you.
Senator Van Hollen. Senator Cortez Masto of Nevada is recognized.
Thank you, Mr. Chairman. I too want my kudos to our ranking chairman. Thank you so much. It's been a pleasure to work with you. I too, we've not agreed on everything, but you are a gentleman, and I do always appreciate the opportunity to have an open line of communication with you, so thank you. To everyone here, thank you. This obviously is something we have been working on for a period of time here, and really appreciate the insight you all bring. I do want to follow up on my colleague, Senator Van Hollen's line of questioning with Professor Allen. I want to ask the rest of you. Clearly, she's supporting banning it. If we don't ban it, how do we regulate it? She put forth a proposal, which is isolate it from the banking system and then define it as a security. Does anybody disagree with that or have any other ideas about how it would be regulated? Mr. O'Leary.
The concept of passing legislation that would ban banks from integrating cryptocurrencies and crypto technology, if that were to happen as an investor, I would short every American bank stock because it would make it the most uncompetitive financial services sector in the world. The innovation that is coming forward, once regulated, is going to be profound in terms of how it changes the cost, the efficiency, the auditability, the productivity of the banking sector. Just look at things as simple as ACH transfers, how archaic they are. Look at the Fed wire.
So let me just stop you there. I only have so much time. So you do not agree with isolating it from the banking system?
That's insanity.
Okay, Ms. Schultz?
No, I also don't agree with isolating it from the banking system. I do think that if I were queen for a day to regulate, I would ask Congress to make some clear lines here with respect to what is and is not a security. And I think a lot of crypto tokens do fall under the category of security, but it's not always clear. I also would ask Congress to draw clear lines as to which market regulator handles secondary trading, giving the commodities segments to the CFTC and the securities segments to the SEC. That should put good guardrails in place in order to apply similar risk frameworks to similar risks.
Thank you. Mr. Shankman.
If we allow cryptocurrency to infect our banking system, we will be back here.
Thank you.
We will be back here, not in a good way.
And Professor Allen, anything else to add? So I'm going to ask you, because I also appreciate your conversation with Senator Tester, and that's really focuses on why we should isolate it from the banking system. But let me ask you this. Many crypto advocates have taken this scandal that we are talking about today as an opportunity to suggest that the failure of FTX was due to its centralization and argue for decentralization finance, or DeFi. Can you talk a little bit, would that have made a difference? And what impact would DeFi lead to possible greater centralization of wealth? I mean, can you talk a little bit about what that means, if anything?
Sure. So DeFi stands for decentralized finance, but that's a marketing term because it's not actually decentralized. As I mentioned earlier, technological decentralization and economic decentralization are not the same thing. First of all, DeFi is highly integrated with the centralized crypto ecosystem, and it's not sure that it can survive without it. And then even within DeFi, there are so many intermediaries. At the underlying blockchain level, you're trusting the core developers of the software that runs the blockchain and the validators who implement the software changes. On the next level up, you're trusting the people who program the application that runs on that blockchain. Now, the people who program that are controlled by the people who own the DAO governance tokens. So you may have heard about these DAOs, these decentralized autonomous organizations. They're basically like creating a partnership on the blockchain. The ownership of those tokens, it's meant to be decentralized and dispersed, but that's not the reality. The economic reality is that for a lot of these things, like 90% of the tokens plus are owned by a single person. So, saying that I could, me having one governance token in a DAO is like me buying a share in Tesla and trying to tell Elon Musk what to do, right? So economically, it's very centralized the whole way up and down. And so, much like many of the stories that Mr. Shenkin's been talking about, it is a story. I really get why people want these things. Wouldn't it be nice if we could create a world where we didn't have to trust intermediaries who have made so many mistakes so many times? But the reality is that economic power concentrates in these places, and we can't avoid intermediaries. So what's the point of DeFi?
Thank you. I know my time is up. Thank you, Mr. Chairman.
Thanks, Senator Cortez Masto. Senator Smith of Minnesota is recognized.
Thank you, Chair Brown. I'm going to direct my first question to Professor Allen. So the collapse of FTX is shocking, but it's hard to say that it's surprising, right? I mean, it's hard not to conclude that this crypto exchange and its related firm, Alameda Research, completely failed to safeguard the money of the people they entrusted their money to there. And we shouldn't lose sight of the fact that millions of dollars disappeared overnight, and that this is money that belonged to people who couldn't afford to lose their money. So, Professor Allen, I want to get at this question of consumer protection pretty quickly. So people are free to invest their money pretty much however they want to, but they deserve to know that the market is fair and that there are rules that protect them from bad actors, so they're not getting ripped off. So exchanges and firms that buy and sell stocks and commodities are required to keep company money separate from their customers' money. They don't get to gamble with their customers' money without asking permission first. Is that correct?
Yes.
And that's not the case with what we saw with FTX, what we see often in crypto. Is that true?
I mean, they often say in their terms of service that they won't do it, but they do it anyway.
Yeah, I think that's right. And when a firm is being paid to give advice to their customers on how to invest their money, they have to put their customers' interests first, right? That's the basic fiduciary responsibility. Is that the case in crypto right now?
So, I mean, I think there's a big concern here about crypto being incorporated into things like pension funds and also into 401k plans. So the Department of Labor has been very clear that they don't think that this is the type of thing that belongs in any kind of sort of retirement saving. Unfortunately, Fidelity has made the move to allow people to invest in Bitcoin through their 401k plans, and I think that's highly problematic.
Yes, and Senator Warren and Senator Durbin and I have sent letters to Fidelity and have urged the Department of Labor to follow up on this because they have this highly volatile asset that does not appear to be, it seemed to be exactly the wrong kind of thing to put in a retirement account where you're looking for more stable, more stability over the long term, right? Right. And let me just ask, just following up on what Senator Warren was focusing on, banks and other financial services firms have the responsibility, the duty to know who their customers are. That's how we protect against money laundering. Is that the case in crypto?
No. And I mean, I think generally speaking, there's sort of a failure of gatekeepers all over the crypto industry. You know, we've talked about we don't have the auditors being able to exercise oversight. We don't have KYC functions there. Another failure of oversight is the venture capital firms, right? We sort of expect them to exercise a restraint and exercise diligence before lending their reputation to these businesses. But venture capital firms were throwing money at FTX and similar firms without doing their diligence. So I think, as I explored in my written testimony, one of the things we can achieve by enforcing the securities laws is actually holding venture capitalists to account a little more because of potential liability as statutory sellers of unregistered securities.
Yep. So I agree with that. I think that the crypto world of FTX shows us what can happen when we don't have basic consumer protections in place. And you know, crypto is a relatively new thing, but we know what to do to make sure that our markets are fair and that financial institutions know their customers. So it seems to me that our job here is to enforce the laws that we have, make sure that we are plugging holes where they exist, and making sure that our enforcement agencies have the authorities and the resources they need, or we're going to see more disasters like this. Mr. Schenken, I would like to follow up and ask you a question. I want to talk about the external impacts of crypto. So crypto mining and verification is a highly energy-intensive process. It requires more electricity annually than many individual countries. The worst offender is Bitcoin, but this is a widespread problem. In the U.S. alone, crypto operations require as much electricity as all home computers or residential lighting, and this is, of course, contributing to our challenges around carbon emissions. And Then there's the issue about crypto mining exacerbating local noise and air and water pollution as well. So lots of externalities, as we say. So as I understand it, crypto mining is built on a process that becomes more and more energy intensive over time. Is that correct?
Yes.
So it's inherently inefficient. Is that
Yes.
correct?
The technology is bad.
And so where is the benefit of this kind of innovation, and how should we think about the impacts of this when it comes to the climate and energy use impacts? Because in fact, when crypto mines are located in communities, those communities often see their energy prices go up, their energy rates go up. Is that correct?
That's right. I visited the largest crypto mine in the country, Whinstone, which is in Rockdale, Texas, just outside of my hometown of Austin, Texas. Local citizens are upset. It raises the cost of electricity for all citizens, and it also uses an enormous amount of energy. It took over a former Alcoa aluminum smelting plant that had been abandoned, and now we are using it to mine ephemeral digital assets of no productive value. I think that says a lot.
Thank you. Thank you, Mr. Chair.
Thanks, Senator Smith. My understanding is Senator Sinema is joining us remotely. Senator Sinema
Yes.
from Arizona.
Thank you, Mr. Chairman, and thank you to our witnesses for being here today. You know, Arizonans are always interested in investment opportunities that allow them to build better lives for themselves and their families, especially in the last few years in conversations at the grocery store, the gym, the coffee shop, or the kitchen table. Arizonans have been talking about cryptocurrency, the hype, the skepticism, the questions of how it works and how it will work going forward. Like most Arizonans, I'm a skeptical optimist. I believe in the future and the potential of this technology, that it can be a force for good, and that it can ultimately make people's lives better. But also clear-eyed about what's happening right now, how technology and anonymity can be misused and abused, and how people are being deceived and defrauded. The collapse of FTX is just one of many recent market events that have shaken investors' faith in the ecosystem. Some will say that this is about the ecosystem as a whole. Others will say this merely applies to centralized entities and that this criticism should not apply to more decentralized projects. But even in the context of decentralized projects, we need to understand how dispersed ownership truly is. So this is a complex issue, but I want to put the focus where it should be, on everyday Arizonans, many of whom put their faith in a technology that appeals to our independent leanings and our natural skepticism of government and centralized control. So I believe we have some obligations to everyday Arizonans. First, to make sure they have the information they need to understand risks and opportunities, and ultimately to make investment decisions that work for themselves and for their families. Second, to grow the U.S. economy and protect the integrity of our capital markets. Third, to provide a regulatory framework that responsibly promotes innovation here in the U.S. while increasing funding for enforcement to ensure that any bad actor is pursued quickly and harshly. So protect investors, protect the economy, promote innovation, go after the bad guys. It's pretty fundamental. So I'd like to turn to Professor Allen and thank him for being here. Your testimony cites a Financial Times article entitled, "Let It Burn," that calls for crypto to do just that, to burn down as a fully unregulated business. So let's be specific. In the cases of FTX, Terra, Luna, Celsius, and others, who exactly got burned?
It was the investors.
That's right. I also want to apologize, Professor Allen. I misnamed you there for a moment. I apologize. In other words, it was investors, right? Everyday Arizonans, people who work hard for the money they make and are just trying to provide for their families, save for their kids' college, or take that vacation they've always dreamed of. The founders didn't get burned, even if ultimately they got arrested. It's regular people who got burned. And that's why it frustrates me when people say flippantly, "let it burn," because that's the hard-earned savings that everyday people invested in good faith with promises of big returns. And for FTX customers, all of that is now gone. Now, most people had no idea they'd find themselves as unsecured creditors, unlikely to get back the investments they'd entrusted to Mr. Bankman-Fried and others. And they're last in line behind banks, lawyers, other lenders, and venture funds. For months, I've had people in Washington tell me and my staff that new legislation isn't necessary here. They say that there's sufficient regulatory authority and that the regulators should just handle it unimpeded. But my question is, where were the regulators? I was encouraged to to see fraud charges pressed against Mr. Bankman-Fried and his subsequent extradition and arrest. But let's be serious, that was reactive, not proactive. And frankly, it's the least that government could do. And perhaps most importantly for all those regular Americans, it's not going to get them their money back. And others will say that this is a classic case of buyer beware. It's clear that due to murky jurisdictional issues, unanswered legal questions, and a lack of regulatory clarity, investors are having a difficult time accurately pricing risk. In finance, we learn that the return on your investment should be related to the risk that you bear. But if you can't price the risk, it's hard to understand what return you should expect. And that cuts at the core of how a healthy market should function. Professor Allen, your testimony highlights a number of ways that greater regulation enforcement can be valuable for investors. And I'm interested in identifying specific ways that we can assist investors in quantifying the risk they may be taking on. Are there specific disclosure or registration requirements that you believe may assist investors in more accurate price discovery?
Thank you, Senator. So first of all, I want to point out that the let it burn argument may seem harsh, and it's not one that I advocate for this reason, but it may seem harsh to the individual investors, but it's advocated in the sense of trying to protect people who haven't invested in crypto from broader financial failure. So it's not as harsh as it might seem. We're trying to find a regulatory regime that can protect non-investors as well as investors, and that's what I've tried to advocate for in my testimony. In terms of protecting investors, as I've said, I don't know how you can really protect them from crypto assets with more disclosures, because what are you actually disclosing about an asset that has nothing behind it? I think that the securities laws are effective in requiring registration, which means people who have assets with nothing behind them won't be able to offer them in the first place. And that, I think, is the value, the ex ante value, as you said, instead of an ex post enforcement action. I think that is the value of applying the securities laws here. And yes, I wish they had been enforced more aggressively in the lead up to this. I think the SEC has not had enough resources. I also think that the SEC has faced a lot of significant political pressure to back off from the crypto industry. It received letters from congresspeople last year saying, don't look at FTX. So I think that full-throated support from Congress for the SEC's investor protection mission could be very effective in increasing enforcement in this space.
Thank you, Professor Allen. Thank you, Senator Sinema. Senator Toomey has one last question, as I do, and then we'll wrap. Thank you.
Thanks, Mr. Chairman. I think during the course of this hearing, we haven't talked as much as we ought to about some of the, I think, really exciting and terrific applications that the crypto ecosystem makes possible. One of the categories that comes to mind is the ability to use stablecoins in conjunction with smart contracts. Basically, it turns into what I think of as programmable money, where you can write into the code a payment that will occur based on some exogenous and verifiable event, and the payment requires no human intervention. It just happens when the exogenous event occurs. So, Ms. Schulp, I wonder, first of all, could you comment on whether you think there's a lot of future in this idea of programmable money? And then secondly, I think you're familiar with the legislative framework that I've laid out for stablecoins. I think the heart of that is the requirement that we have 100% cash and cash equivalents as a backing for a stablecoin, and oversight by the OCC, but not the Fed. And I wonder if you would comment also on whether you think that is the right approach to regulating stablecoins.
Of course. So I do believe that stablecoins have a lot of promise, not only in terms of the programmable money concept that you state, but also in terms of just being a faster and more stable way to work within a digital ecosystem rather than relying on kind of our current creaky payment rails. Stablecoins can offer a lot of alternatives in that space where we have truly digital money. I am familiar with your legislation, and I think that it addresses what is one of the, I think, most obvious risks in the stablecoin space, which is the concern that stablecoin issuers do not have stable coins because the reserves that they have behind them might not be what they say they are. I think that there are a number of ways that you can go about creating a regulatory regime to take account of that risk. I myself have proposed kind of a disclosure-based framework that could be put into place by something like the SEC. In fact, it's very similar to the disclosure framework that you have proposed with the OCC. I do think it's important to separate that type of regulatory function from the federal monetary regulator, so that the Federal Reserve is not the one charged with handling regulation of kind of a money substitute here. There's a lot of conflicts of interest that can exist in that space, and I think it's wise to keep stablecoin regulation, which is something that I think is kind of low-hanging fruit at this point. There's obvious risks, and I think there are pretty obvious ways to deal with those risks in pretty simple fashion. But we should keep that type of regulation separate and apart from monetary regulation.
Thank you.
Thank you. And my question, in fact, thank you for that answer. Professor Allen, my question is in part follow up with your answer to Senator Sinema about the difficulty of regulating crypto. Crypto firms have called for regulatory clarity, is a term that some of them use. Do you think crypto platforms could mostly comply with actual regulations?
No, I don't. And I think when they're calling for regulatory clarity, what they're asking for is bespoke regulation that they can comply with.
Okay, good answer. Thank you. Thanks to the witnesses for your testimony. The events of this week should be a warning to others about accountability, not just in crypto. How we discuss crypto from this point forward will define crypto markets for the future. For senators who wish to submit questions, for the record, those questions are due Wednesday, December 21st. Witnesses, we ask you within 45 days to respond to any questions. Thank you again. The committee is adjourned.